My name is Alex Boggis and I'm responsible for business development in the UK. I will give a quick introduction and watch for questions during the presentation. I suspect that you are now all experts on Zoom questions, but there is a question tab that you can click. Any issues you can PM me. I'll try and look during the presentation. And I'll compile the questions for the end and get the speaker to work through them. Now, the premise of today's talk is about India and whether or not it should be considered as a separate investment to, say, simply holding an Asian or an emerging markets fund. I note that in the UK, investors do not tend to have a separate country-specific fund in their portfolios. The exception might be China, which has been creeping in. If you access emerging markets in Asia, you are likely to have a very low active weighting to India, but a high one to China. We believe that whilst both markets have their merits and in fact have different drivers, it's time to reconsider the India weighting, and that means take it higher. You cannot rely on your investment manager to make this move. Alquity has done so, and I hope that Mike and the team are going to explain why and when you should consider this too. But just before I hand over to the team, please note that first of all, I need to move the slides. Please note that everything that Alquity does is through an ESG lens, as a reminder, and that includes in India. Alquity is delighted to be rated AAA by the UNPRI, but please also note that we have the label ISR rating, which we've held for a number of years. Unlike the UNPRI, this is not a tick box exercise. It's a yearly audited outcome, and we are justly proud of it. Further, when it comes to India, as part of our Transforming Lives initiative, which most of you will know about, where we give 10% of our fee revenue to projects on the ground, I'm delighted to say that India features very strongly and we've had great success there. So I'm happy to follow up on this aspect of our business at any time after the presentation, but for now, I'd like to hand over to Mike to begin talking and enlightening us about India.
Great, thank you very much, Alex, and good morning, good afternoon to everybody. Just for those of you who don't know me, my name is Mike. I'm the head of Global Emerging Markets at Alquity, and I've been investing in emerging and specifically India for 25 years. And there's a team of 6 investment professionals here at Alquity, and I'm joined today by Kieran, who is our Associate Portfolio Manager, who's been at Alquity for a couple of years now, and previously was at British Petroleum Investment Management. So without further ado, let's move on to slide 4. And I think it's highly noticeable that both India and our funds have been outperforming over the last 6 months. So this slide is in US dollars, and the Alquity India Fund is up 32% in the last 6 months to the end of February, outperforming the Nifty index. But interestingly, India overall has outperformed both emerging, which is up 20%, the FTSE up 15%, and the S&P that is up just over 8%. Now, the key thing is, why is this happening? And more importantly, why do we expect this trend to continue? And on slide 5, no presentation, unfortunately, is complete these days without starting talking about COVID. The chart on the left shows India's experience of COVID over the last year with their daily number of new cases. And it peaked at 100,000 over in the summer before coming down dramatically. And there were very fair and valid concerns that India wouldn't be able to cope with COVID, given all the issues that we think of when we think of that country. And I think it's fair to say that their experience has been dramatically better than anyone could have expected. As you can see from the chart, we're now seeing a little bit of a second wave in the last few weeks. This is driven by a few specific hotspots. And in the same way that the first wave didn't really cause any major issues in the same way as it has done in perhaps Brazil or parts of Europe, we're not overly concerned about the impact over the medium term. And there's a number of reasons for this. Firstly, the reason that many of us like India is because of its favorable demographics. It has a really young population. And we know that that is very, very helpful when it comes to COVID, as we've seen in India's first wave. And sad to say that India has experience with a large number of diseases. And the mentality on the ground very much is this is another one of those diseases that they need to learn to live with rather than locking down as aggressively as we have done in the West. It's also really interesting that a number of regions are about to reach herd immunity from various surveys that have happened. So in Hyderabad, which is one of the big cities in the south, in an antibody test, 54% of people have developed antibodies already, which obviously makes the chances of a very difficult second wave less severe. And India is actually vaccinating very quickly. When we wrote this just a couple of weeks ago, 35 million people had a first dose. That's now at 45 million already. They're vaccinating about 2 million people a day. So again, they're set pretty well for the future months, despite the current level of noise about the second wave. So now moving on to slide number 6. Linked to this, we expect to see India's GDP to bounce back very strongly. The chart on the right at the top shows real GDP, and last year, unsurprisingly, it declined by around 7%. But this year, we're expecting a double-digit increase. That'd be one of the fastest increases globally coming out of the COVID situation. Also, on the chart on the right shows the situation with inflation and interest rates. The main interest rate is the orange line, inflation is the red line, and the purple is the real interest rate. And we expect loose monetary policy to continue, with real rates being negative to neutral until we see that pronounced rebound. Turning to the external profile, the trade deficit has declined from over 2% to just 1.8% last year. The current account has turned into a surplus, and we expect it to be roughly in balance this year. And despite the higher oil prices, we don't see any major issues at these or indeed slightly higher levels. Foreign exchange reserves are at historically high levels of about $580 billion or 12 months of import coverage. So the macroeconomic outlook is very strong as we move into the next 12 months. And on the next slide, we show a slide showing earnings, and this is quarterly earnings growth for each quarter as a year-on-year change going back to December 2015. And on the far right, you can see that in the quarter ending September and the quarter ending December, we've seen very strong earnings growth for Indian corporates. And remember, this is without a very favorable COVID base effect. This is while COVID was still going on. And it's the rural recovery that we've been talking about that has led to this acceleration of growth. And you can see over the last 5 years, there's no period where you've seen such strong growth for 2 quarters combined. So this recovery isn't something that's going to happen in the future. It's already here and now. However, India is so much more than just a cyclical recovery, as you can see on the next slide. There's structural reforms going on as well. And the major one was the goods and services tax, which created a level playing field for taxation in 2017. That's helped shift the economy from the informal to the formal sector. And India, given its relatively undeveloped nature, this is an extra source of growth that is meaningful in India that you don't see in markets such as China and Korea. And even now, the informal economy remains very large, which is a good opportunity for future growth. It accounts for 20 to 40% of the electrical sector, 95% of road logistics, almost 3/4 of clothes manufacturing, and almost half of tile manufacturing. In addition, we've seen labour reform. India's labour laws are highly restrictive, and the relaxations of those that we saw last year will increase India's attractiveness as an investment destination. We're also seeing deregulation in agriculture. The protests and negotiations with the government continue in this field, but we think things have quietened down and we expect to see further progress. We also expect to see privatization of public sector or SOE companies over the coming months, and further reform, such as land reform. The ownership of land is very fragmented, it's very bureaucratic, and this again will be a key enabler for India's future growth. We also expect to see deregulation of the electricity sector and opening up of the sovereign bond market for non-resident investors. So reform will continue. And on the next slide, you can see why this is possible. Modi's position has only strengthened in India between his first term and his second term that we're now in. The pie charts at the top show the number of seats that the NDA, the government in blue, had in the first term, 282, versus now 333. Modi increased his majority in the lower house in the last election in 2019. But he's also, which is perhaps less well known, increased his position in the upper house, the Rajya Sabha. And at the bottom there, you can see the NDA, the government, with 66 seats in the previous term. That has now increased to 93. And the opposition, the UPA, has decreased by almost 50%. The smaller parties have increased their share to 116. That means with Modi's party having more seats and more smaller parties, he now has an effective majority in the upper house to get things done, which is not something that he had in his first term. And we mustn't forget that the national election isn't due until April 2024. He has plenty of time to continue with these structural reforms. On the next slide, we just compare India to the other big market in Asia of China. And starting on the chart on the right, you can see that India will overtake China in terms of its overall population size in 2027. It will become the world's largest country. It already has the world's largest young population, which is a key structural driver for growth. India's urbanization levels are significantly lower than that of China at 34% versus 59%. And that, combined with the large informal economy shifting to the formal economy, are further sources of structural growth. You can say India is like China 10 years ago or 15 years ago, if you want to put it in those terms. And unsurprisingly, we see, using Bloomberg data, that the next 5 years will see much stronger earnings growth in India at 84.5% versus just 50% for China over that period. Also, the increased geopolitical tension we've seen over recent years between the West and China also plays to India's strength, as aligned with the West, a large, vibrant democracy, it's very different to China. And for people wanting supply chains to be diversified away from China, India is an increasingly attractive destination. And as Alex said at the start, people haven't always had a dedicated allocation to India. And I think we've seen over the last couple of decades how well that's done when they did that with China. And we would say that now is the time to think about that for India. And the Indian market, and specifically our fund, has a very low correlation to that of China, only 35%. What drives Alquity India and what drives China are two very different things. And so this can act as a great portfolio diversifier. And finally, in this section, in terms of us specifically, on the next slide, our strategy it has been successful and also is highly repeatable. And there are a number of reasons why we have delivered those strong returns. We have a very deep understanding of India. India is not the same as China or the West. And having been analyzing the market for 25 years, we have a significant advantage versus many of our peers. Secondly, ESG and impact are becoming increasingly important. And this is something that investors perhaps based in Europe and the US have a massive advantage versus those on the ground in India and in Asia, where these themes are much less prevalent than they are for us. So the combination of our understanding of India and our ESG and impact focus give us a unique advantage. Our process also is certified, as you can see, by the label ISR in the top right-hand corner. And given India is a retail-driven market, almost half of daily volume is driven by retail investors. Having a very deep, fundamental, and certified process gives us an advantage to pick up great companies amidst the volatility of a retail-driven market. And that's something we've been very good at over an extended period. Perhaps even more importantly, we focus on the India of tomorrow. India is changing and will continue to do so. And we want to own those companies that have a long-term structural opportunity to benefit from that change. So 2/3 of our funds has a market cap of below 10 billion. Only 18% of the index has companies of that size. And our active share is 75%, which is highly meaningful. And in terms of sustainability, we're really pleased and proud that we have 5 Globe ratings, which is the maximum for Morningstar in terms of our sustainability. And so the proposition of Alquity India really is genuinely unique versus other opportunities out there. So having talked about why we continue to be very positive on the outlook for India, let's now delve down on the next slide in some of the really exciting opportunities that we see in India. And on slide number 13, I just want to talk about how we've shifted the portfolio over the last 3 or 4 months. The second row there shows quarterly GDP growth for the agricultural sector in the context of the economy as a whole. And you can see last year, despite the ravages of COVID, each and every quarter, agriculture delivered growth, as we expected, given the favorable monsoons we've seen for 2 years now. That's in the context of the top row of real GDP, which was very negative in Q2 and Q3 before recovering slightly in Q4, driven by manufacturing, construction, services, etc. So last year, the rural economy, where we positioned our portfolio, significantly outgrew the urban and the overall economy. But that's now changing. The rural's still doing fine, but the urban is bouncing back, as you can see in the fourth quarter, with financial services up 6.6%, or construction. And so we've tilted the portfolio heavily from the rural focus towards more of an urban focus. And I'd now like to hand over to Kieran to start talking a little bit about one of the themes within that.
Thanks, Mike, and thanks for joining. So Alex, next slide, please. Thanks. So infrastructure in India, this has been a multi-year structural growth story, and we've seen accelerating progress, particularly since the Modi administration began in 2014. So looking at the graph, you can see that during the previous administration, the average road construction was about 12 kilometers per day. And as indicated by the green arrow, during Modi's first term, this had more than doubled to about 27 kilometers per day. And I think what's really interesting is that for the 11 months up to February 21, which includes most of the lockdown period, there really wasn't much of an impact on the numbers. And that's really because there was a very strong bounce back soon after those lockdowns. And in addition, we think that in the next 12 months, this figure is likely to exceed 30 kilometers per day, which is a staggering amount of infrastructure. Alex, if you can move to the next slide, please. So Modi's strategy to accelerate infra growth has continued pace, and the February budget was a really good indicator of this. So it set infrastructure spend to increase by 34% to almost $80 billion US, and a portion of this goes towards building roads, which is very positive for the cement demand outlook. But another significant portion goes to affordable housing, which is an even more important part for cement demand, given housing contributes 65% to total cement sales. Now, you may know that India faces a pretty serious housing problem. The projected shortfall is at around 90 million households by 2022, with the rural areas suffering disproportionately. And given the focus that the government has on increasing housing supply to address this deficit, building roads, amongst other factors, we're really positive on the outlook for cement demand, and it's expected to grow at around 15 to 17%. And on the right-hand side, you can see that the demand is expected to outstrip supply for some years to come. Now, we are cognizant of the environmental impact of cement production. However, given a lack of suitable alternatives, cement is simply a necessity in addressing the SDGs, particularly SDG 11, which says that all people should have access to adequate housing and upgrade from living in slums. So to us, the trade-off is quite clear, but we will only select the companies that perform the very best in terms of ESG metrics. So we hold Ultratech, which is the largest cement player in India, and their CO2 intensity is 10% below domestic peers, and actually 33% below global peers. And another holding, Heidelberg Cement, is net water positive by sixfold, meaning it collects 6 times more water than the company consumes. So to summarize, the infrastructure growth story is positive and accelerating, and it's particularly supported by the accommodative budget, and that makes us very excited about the outlook for cement. So handing back to Mike.
Thanks, Kieran. On the next slide, we continue with this theme where we show you one of the stocks in our portfolio, which is TCI Express. This was listed in 2016. We bought it in 2017 and has a market cap of around $400 million. So it's certainly one of the stocks that are the future of India. This is a surface express delivery operation focusing on business to business. It picks up parcels from 40,000 locations and has over 200,000 customers. We see monetizable structural growth given the shift from the unorganized sector, as we highlighted earlier, was 95% of the industry. And TCI is growing around double the rate of GDP growth, which in itself is growing pretty fast. They've invested heavily in technology and automation, and their margin expansion is really underappreciated by the market, we believe. And the much better infrastructure, as Kieran's just talked about, again, is a positive for TCI, which means they can have greater efficiency, less delays, etc. So we're expecting around 40% EPS growth over the next couple of years, each year. It's debt-free. It trades at a 45% discount to its nearest peer. We rate it a C for ESG. And we've been engaging with them on their focus of trying to use greener vehicles in India. On the next slide, we continue with the connectivity theme, but in a different way. And this is Polycab, which is the market leader in wires and cables. Again, this listed in April 2019, so is relatively less well known by investors. It has a market cap of just over $2 billion. We've owned it since January 2020. And given the focus in India on infrastructure, housing, urbanization, you need wiring for all these things. And so Polycab will benefit from those growth trends. It also has a good moat. There are only 4 major players, of which Polycab is one, and has an extensive distribution network of 137,000 outlets. Again, the shift from the unorganized to the organized sector, again, is another growth opportunity. Polycab is 20% cheaper than its peers, has a C grade for ESG in our proprietary rating system. And our focus here in terms of engagement is on increased disclosure of environmental targets. Shifting now from electricals to electronics on the next slide, we talk about Redington. Redington is the leading Indian distributor of various IT products such as smartphones, laptops, etc. So clearly it has a very strong growth opportunity as we shift from the physical to the online economy. And it has a good moat due to its very deep relationships over decades with Apple, Dell, Samsung. And it's a duopoly in India, with themselves and Ingram being the main 2 players. The secret of distribution is working capital, and their working capital management is exceptional and has been for decades. We've owned this since May 2019. It has a market cap of below $1 billion, and its single-digit forward price to earnings does not reflect the growth opportunity. Again, this is a C grade. And our engagement focus here is for them to produce a sustainability report, which we're expecting before too long. So now I'd like to hand back to Kieran to talk a little bit more about Dixons.
Thanks. So Alex, on the next slide, please. Great, thanks. So made in India is perhaps not a commonly used term when it comes to manufactured goods. Rather, it's more synonymous with IT software in the context of India. However, this has started to change in recent years. Companies around the world have moved manufacturing away from China towards other countries, including India. And the first reason is that supply chains were just overly concentrated in India, and the process to diversify away started some years ago. But this trend is likely to continue at an even faster pace as the pandemic has revealed the inadequacies of many supply chains as a result of overconcentration. The second reason is that India's cost of labor is simply much lower, running at about 150 US dollars per month for laborers versus China's 500 US dollars. So that's almost a threefold difference, or more than a threefold difference. And lastly, the government has set multiple incentive schemes for domestic manufacturing, with subsidies totaling more than 9 billion US dollars to date. And that's already enticed a number of multinationals. It's also worth noting that this is really early days for India. For example, it has just 1% market share of the global electronics manufacturing industry, but is expected to grow over 50% per year for the next 4 years, reaching 6% global market share. And one of our holdings, Dixon Technologies, is a key beneficiary of this trend. Dixon's is a third-party electronics manufacturer serving some big multinationals such as Samsung, LG, Toshiba, Nokia, as well as Chinese brands like Xiaomi. And we're very positive on the earnings outlook. We're approximately 5 to 10% ahead of consensus earnings, given their very strong order book, the elevated levels of inquiries, as well as their new capacity onboarding. So putting this all together, we expect around 45% upside in our base case DCF calculation. We rate Dixon's a C on our ESG rating system. In particular, they're not disclosing GHG and waste production metrics. However, we do know they're recording the information, and thus we expect that Dixon's will improve their disclosures over time. Back to Mike to discuss other aspects of the portfolio.
Great, thanks, Kieran. On the next slide, I just wanted to highlight how investing with us at Alquity has a real impact in the world. And I've got a few examples here. Firstly, Amrutanjan, which is one of our large holdings. It's a 125-year-old pain management balm. So it's a very well-established consumer brand. And it's recently moved into female hygiene products. There's a market niche here because these have been traditionally very unaffordable in India. And sanitary napkins are only used by 57% of women in India aged between 15 and 24, predominantly due to lack of availability and expensive prices. And Amrutanjan's product is significantly cheaper than the peers. So not only is it a very strong growth opportunity for the company, it also works towards SDG 5, gender equality, and SDG 3, good health and well-being. And the brand strength of Amrutanjan has been confirmed by our Transforming Lives consumer panel, which I'll talk about in a moment. Secondly, Astral. This is a leading manufacturer of PVC pipes, which clearly will benefit from rising urbanization, but also it is absolutely key for sanitation, such as toilets, etc. And they published a social media campaign, which I would urge everyone to go onto YouTube and watch, which really challenges gender inequality and lack of female access to toilets. And then finally, Fool. You'll recall from the start of this webinar, we talked about our virtuous circle, delivering attractive returns with a very strong focus on ESG, but we donate 10% of our revenue to projects in the areas that we invest in. And Fool is a social enterprise that we've supported. And Fool take the surplus flowers from temples in India that otherwise would be thrown into the rivers and make incense sticks with them, therefore reducing environmental issues and also creating employment. So therefore working towards both SDG 6 and SDG 8. And so by investing in the Alquity India Fund, you're supporting enterprises like this. We go further than that. As you can see here, myself and Kieran meeting with some of the beneficiaries a couple of years ago, and we've formed Transforming Lives consumer panels where we discuss the products that these consumers use, their aspirations, which banks they use, buying houses, e-commerce, this kind of thing. And this gives us a greater insight than most fund managers have, who would typically go to a conference in Bombay or something. And this very different demographic obviously has very different needs and aspirations than the middle class in Bombay. And this then feeds right the way back into our portfolio analysis and construction. And it means the way we look at India at Alquity, and indeed all of Asia and emerging markets, is genuinely unique versus any of our peers, which we believe really helps deliver performance. Sticking with the impact theme on the next slide, just talking about India's changing environmental footprint. And India has rightly had a very bad press when it comes to environmental issues. And this is changing, albeit very slowly. The chart on the right shows India's solar installed capacity, which has accelerated dramatically over the last couple of years. India targets 40% clean energy by 2030. They've ratified the Paris Climate Agreement. However, we steer clear of direct exposure to power generation because of concerns with governance with a number of the companies, and also with stretched working capital requirements, which is a perennial issue when it comes to the Indian power sector and anything government linked. So we avoid that. Where we prefer to engage is at the corporate level, in line with our published key progress indicators. We want all of our companies to publish their emissions and to come up with defined targets to reduce their environmental impact over time, and hopefully by 2030, but certainly by 2050. And so we engage with our companies, and we're seeing increasing usage of solar and wind power for companies such as Astral, such as Hero Motor. And this is how we believe we can encourage Indian companies to become greener, by engaging at the corporate level rather than just investing in a renewable energy company where we have concerns. So on the next slide, you can see our portfolio here. On the left is our sector breakdown. The domestic theme that I've talked about runs through the portfolio, with building materials, financials, capital goods, autos, etc., dominating the portfolio. On the right-hand side, you see our top 10 holdings. I've mentioned a number of these names already. My point is that this is a very, very different top 10 to our peers. We're focusing on the India of tomorrow. And then you can see below the split of the portfolio by ESG rating. C grade are the majority. We have 15% in B and 8% in A. And what we found is that a C that becomes a B, that becomes an A over time, is a really good way to generate alpha for the portfolios. VMart, one of our traditional holdings, is a case in point of that. So on the next slide, we turn to the issue of valuations, which is always very topical in India. India will never be a cheap market in the sense that Korea is, because India has multi-years and decades of growth, whether that comes from the demographics, the population growth, the low but rising levels of urbanization, or, as many people forget about India, the shift from the informal to the formal economy. That said, the way we've looked at this here is to compare India's trailing price to book to that of emerging markets as a whole. And you can see here that although we're off the lows of last year as the economic momentum has gained, we're nowhere near the valuations that we think we should be, given India's structural growth opportunities, let alone the cyclical tailwinds that we see. So whilst we're conscious that valuations in India are perceived to be at more expensive, it doesn't give sufficient justification for what you're buying in India. And therefore, we do absolutely see value there. Now, on the next slide, turning to performance, and our strategies delivered strong performance over a consistent period. So the fund has delivered 34.5% growth over the last 6 months versus 25% for the index, which is top quartile. Over 1 year, we're behind the index, but we're still second quartile. Over 5 years, again, top quartile. And since inception, which is coming up for 7 years now, we're second quartile. You'll note that over 3 years, we have a little bit worse numbers. This comes from our domestic focus when India was having an economic down cycle. That clearly isn't the case at the moment. Combined with a couple of stocks that didn't work for us. And we've analyzed the issues. And as many of you know, we've really enhanced our risk control process across all our funds, including India. So such a performance outlier should not reoccur. Now, over the last 6 months, delving into what's been working and what hasn't, the Made in India theme, such as Dixon's, has been a strong performer for us, as has Sequence Scientific, which is animal healthcare. Companies that benefit from the domestic growth recovery, such as Chola on the rural side, Reddington, and then Kajaria and Samani on the urban side. And through our ESG process, we don't have any exposure to the Indian energy sector. And that has worked very well for us. What hasn't worked so well? Tata Motors. We don't own the company due to ESG reasons. And that's done very well. But we prefer Jamna Auto, which also has done pretty well. TCI Express, as I talked you through the investment story, that hasn't delivered yet. We expect that will do as investors wake up to the story in the coming quarters. And then Escorts, the tractor company, did very well at the start of last year, has come off a bit, and we've been adding back to that as we expect to see another leg of the growth story in the coming months. So finally, to conclude on the last slide, the outlook for India remains very strong in the medium term. The COVID's worsening at the moment, we believe, will not derail the investment case. It provides a very attractive opportunity to invest in the markets. And India's experience with the first wave bodes very well indeed for the second wave. The structural long-term trends, demographics, urbanization, the shift from the informal to the formal economy are intact. And we're seeing a sharp V-shaped macro and corporate recovery already. Politics is stable. We've seen reform. We will see more of it. And we don't believe this is effectively priced in the context of emerging markets. We're different because we have a highly experienced team. Our ESG process is tried and tested and works. And we have meaningful impact characteristics, both in terms of the fund and in terms of Alquity overall, which again makes us unique. But perhaps even more importantly, we focus on the India of tomorrow. And that's key because India is changing. That gives us a very different portfolio and one that is delivering, and we believe will continue to deliver very strong returns over the medium term. Thank you very much. I'd like to hand over to Alex to chair the Q&A session.
Right, thanks very much, Mike. Very interesting presentation. A lot of questions. Where to start? I think we'll start with the macro hat on, sort of top-down approach, if that's all right, Mike. So the first question I'll post is, I'll read it verbatim. The rise in inflationary expectations, I think that means global, plus concerns that policymakers may tighten earlier than expected is weighing on risk assets. How much is India immune to this problem? And there's a comment, back in 2013, India was part of the Fragile Five. So inflation a problem in India, and what's it done to solve the problem, if it is or isn't? Mike, you're on mute.
That famous phrase for 2020 and 21. That's a great question. And let's split it two ways, India specifically, and then the international impact. So although we've seen a little bit of a tick up inflation in the last month or so, the Reserve Bank will look through that. They've been very clear that they want to stimulate the economy with loose liquidity, and any temporary spike in inflation due to temporary supply side issues will be looked through, and they have a history of doing that. So we don't see any issue there in the very short term. In the more medium term, India's deregulation, greater infrastructure, all these are supply side measures which will keep inflation at a lower level in the longer term than has been in the case before. So for India specifically, no issues there that we see. Internationally, as we mentioned, the level of foreign exchange reserves has risen dramatically. India's relatively immune to what's going on globally. And we saw that in the sell-off in emerging markets over the last couple of weeks. India behaves much better. It's always been driven by its own tune versus what's going on globally. And the economic strength has only increased over the last couple of years. That said, the risk is oil. If you felt that oil was going to go to $80, $100 and stay there for an extended period, a year, then that is where India's Achilles heel is. Now, we don't see that. So again, it's a risk that we don't see coming to fruition, but that is where you would be concerned. So to summarize, domestically, inflation isn't a problem, both in the near term or more long term, and India's sensitivity to the global issues are one of the lower ones. And therefore, we think it's a good time to be looking at India within those things.
Thanks, Mike. Another macro question of sorts, but related to global flows, is China has benefited from significant inflows due to index rebalancing, both in equity and bond indices. What can be expected for India in terms of potential weighting increases in EM indices?
I think it's clear it's only going to go one way, which is up over the medium term. Now, if you cast your mind back 20, 30 years and the weight that China was in indices then to where it is now, that's been driven by GDP growth, earnings growth, more companies listing. And India is China 10, 15 years later. And so I think it's a one-way street. And if we look back in 20 years' time, and hopefully I'll still be running the fund, I'm still quite young enough to be saying that, we will see India at a much bigger weighting in emerging markets, as it should do, given its growth potential, its size, and its population.
Okay, great. Okay, another question, more inside India. On appreciating the move of your investment focus from the agricultural sector to the more urban-related infrastructure and services, what is the government urbanization strategy, and does this impact your decision for the shift?
So the government wants more urbanization in exactly the same as China. And there's been some incentives recently to encourage people to buy houses in particular states. So it's a favorable tailwind, but I would say it's probably 10% of the story. People generally want to move from the rural areas to the cities to get a better job, a better life. Exactly as we saw in Western markets, in the 1800s, we saw in China a generation ago. India is exactly the same. It's a really, really powerful trend. So that's been going on for some time. And now you have the cyclical recovery in urban markets, as well as that structural trend. That's why we've reorientated our portfolio that way. So the government is helpful, but it by no means is the main or even a particularly important driver.
Okay, thank you, Mike. And staying on a sort of sectorial or thematic base, what steps have you taken, or otherwise, in the recent tech sector downturn?
Another excellent question. So India's tech companies didn't really perform very strongly as the tech market in the States and China inflated over the last few months. So therefore, there wasn't stretched valuations, if you want to look at it that way. But they did come off in sympathy. And so we used that as an opportunity to top up some of our weightings in Infosys and Tata Consultancy. The shift globally to a digital world, a digital economy, is benefiting these companies because every kind of customer is wanting to become more and more online. So despite a difficult outlook for Europe, the UK, and to some extent the US, you're going to see growth through this digital transformation. Indian companies are well positioned for that, and so we've added to that in this weakness, though the vast majority of the portfolio is domestically focused and urban focused within that.
Okay, thanks, Mike. Now we're going to try and finish by 10:02. There's a lot of questions here. I'm going to pick 3 and see how we get on with them. This one is a bit more about ESG, so an interesting one to change hats. Thanks for a great presentation. Thank you for saying so. Looking forward, do you think a carbon border adjustment mechanism in the EU will have a material impact on industrial/manufacturing earnings in India due to the high carbon intensity of production in the country? So will what's changing in EU, how will it affect India, I think is the question.
Yeah, this is part of our horizon scanning, and in terms of how things will change in India, maybe not this year or even in 3 years, but in 10 or 20 years. So when it comes to companies that are part of the Made in India theme and that are exporting to Europe, we have very little exposure. However, the ones that we do have meet global standards and absolutely would be able to cope with that higher pricing of carbon that we will see in Europe. Now, the vast majority of the portfolio is India focused, and this is something that will come to India at some point, but I don't see any signs of it in the next 5+ years. If you look at even China, their carbon trading system only really came into fruition this year, having talked about it for years and years. So it's something that is on our radar screen. It's something that matters for the very few companies that export and their position to be able to cope with that. But it's not something that I think is going to be a major impact in the portfolio in the near term. I mean, from a world perspective, we'd obviously love India to do it quicker, given how big a pollutant they are. But I think they'll be on the slower end of the scale, unfortunately.
Thanks, Mike. So last couple of questions. First one's about a potential issue. The second one is about more optimism, I guess. Are the farmers' demonstrations not a worry for you? How much could the reform process be postponed or slowed down due to it?
So the reform protests, there's a couple of elements to this. Some farmers, many farmers, are absolutely fine with the deregulation that we're seeing, because it gives them an opportunity to get a better price for their crops. Others clearly have been demonstrating, and these are the ones that have perhaps been supported more greatly by the government over the long term, and they're worried about change and how it will impact them. Minimum support prices for agriculture are not changing, so that safety net is there. And there's clearly a political element to the demonstrations as well, with the majority of the farmers coming from the Punjab, which is a state which the BJP aren't particularly strong in. So I don't think it's black and white, and I don't think it's a case of the government being particularly outrageous in what they're trying to do. The Economist, a magazine which isn't a particular fan of India and certainly not of Modi, actually has said that these reforms are not particularly egregious either. So I think there's various elements to it. Now, in the worst case, say they're cancelled, that means you go back to the status quo. You saw the very strong growth that we saw in the rural sector last year. That was before any of this reform happened. So it removes an opportunity for even stronger growth in the future, but it isn't a negative in the near term in terms of what's already happening. It's an opportunity cost in that worst case, but I don't think the worst case will fructify.
Thanks very much, Mike. And I'll try and make this the last question. Is the Indian market focused mostly on the domestic market, or do you see a growth in the global market for India to compete with other large countries like the US, China, and the EU? I think you sort of answered this, but maybe there's more to add.
Yeah, there's a couple of bits to it. So the Indian software sector has always been globally competitive. And I remember 25 years ago, again, when this was just starting and no one believed the Indians were able to produce very high quality software engineers. And of course they could. And that's been a great story for decades. The Made in India story that Kieran talked about in terms of electronics manufacturing, India is very late to this party, but it's now following the same roadmap that China, Thailand, Vietnam followed, with incentives for manufacturing, cheap labor, a greater reform to make it easier to set up factories, and also tariff barriers to rule out cheap imports. So we expect to see very strong growth there over time. Will it get to be the same size of Thailand or Vietnam? Not for many, many years. But if India can harness its massive domestic market to create a globally competitive manufacturing base that then can increasingly export more, then they're in with a very strong chance. And so this is a trend we've had an eye on for 2 years, but it's something that is now an increasing part of the portfolio. So early days, but yes, I do believe they can do it.
Great, so thanks, Mike. So look, I've tried to get most of the questions in by amalgamating some of them. If I missed the point or didn't get your question in correctly, please feel free to send me or your rep, Alquity rep, a question by email, and we'll get it answered by Mike and the team as soon as possible. With that being said, it just remains to say thanks very much for joining. I hope again that this was an interesting presentation. Thanks to Mike and the team for speaking. Hope to see you again. And remember, think about India. Thank you. Bye-bye.